Hello, dear traders. The goal of the videos published on our channel is always to explain the market in the simplest and most understandable way possible. We put in as much effort as we can to achieve this. Guys, today we are together again with a brand new technical analysis video. In the previous video, we took a detailed look at the cup and handle pattern. Today, we will examine the exact opposite, the inverted cup and handle chart pattern, which signals bearish movement in the market. Dear friends, before getting into the topic, there is something I need to emphasize. Everything in this video is for educational purposes only. What I share is not investment advice. All responsibility is yours, so please manage your own risk. This video will cover the following topics. Introduction. The inverted cup section. The inverted handle section. Entry, risk management, and targets. Validity rules and the most common mistakes. Real chart examples. Dudes, before getting into the details of the inverted cup and handle chart pattern, let's clarify what this pattern means and its main logic. The inverted cup and handle is a continuation pattern that usually appears during downtrends. This means it points to the continuation of the existing trend rather than a trend reversal. There is already weakness in the market, and this structure tells us that selling pressure has not ended yet and that price may continue to move downward. It is called the inverted cup and handle because of the shape it makes on the chart. The price rises to form a rounded top, then pulls back slightly. It looks just like an upside-down cup, which is where the name comes from. We'll take you through the chart step by step, showing exactly how this pattern forms and what to keep an eye on. Now, let's focus on the most important part of the inverted cup and handle price pattern, the inverted cup itself. On the chart, it appears as a rounded, slow-forming peak. Imagine the regular cup pattern, where the U-shape opens downward. The inverted cup is the opposite. The U-shape faces down, like an upside-down dome. What does this tell us? It shows that attempts to push the price higher are failing. Buyers try several times, but each attempt loses strength, and the price starts moving down again. The main point here is to see that selling pressure in the market is gaining momentum. The inverted cup signals that the current downtrend could continue. The ideal structure here is a wide, rounded peak. If the pattern forms a sharp V, rising and falling quickly, its reliability drops. What we want is a process where the market tires gradually and builds pressure. Volume usually supports this structure as well. As the price forms the peak, volume decreases, showing that buyers are losing strength. Simply put, the inverted cup acts like a pause in the downtrend, a short attempt upward, loss of strength, then the trend continues. Once the inverted cup is complete, the neckline, or support level, of the pattern is established. All movements happen above this neckline. Now, it's time for the handle, which will test this support. We've seen the inverted cup part of the pattern. Now let's look at the inverted handle. The inverted handle is a short, narrow upward move that comes after the top of the cup. In other words, once the inverted cup is complete and the price nears the neckline, we see a brief recovery move. This is the handle, usually forming a U or V shape. One key point is that the handle shouldn't be too deep compared to the height of the cup. If the handle is too long or large, the pattern can lose its validity. The most important thing is that volume should drop noticeably during the handle's formation. This decrease shows that there isn't a strong group of buyers behind the price attempt, meaning the upward move is weak. The inverted handle represents the market's last moment of hesitation. Buyers try to push the price up, but sellers are still in control. That's why a break below the handle usually signals that selling has resumed and the downtrend is likely to continue. Dear friends, traders widely use two entry strategies when trading based on the inverted cup and handle chart pattern. The first strategy. Some traders consider the safest point to enter a trade is right when the support below the handle breaks. Entering as soon as the bottom of the inverted handle gives way is known as an aggressive approach. When the price breaks this level downward, it shows that selling pressure has returned and the downtrend could continue. The second strategy. Other traders wait for the price to pull back after the breakdown, testing the level as new support, and enter from there. This method provides a safer entry because it helps filter out false breakouts. Waiting for the price to test the support after the breakdown is considered a cautious approach. When setting a stop loss for the inverted cup and handle trading pattern, there are two main risk management strategies. The first one is a more cautious approach. Here, it makes sense to place the stop loss at the top of the handle. That way, if the price unexpectedly moves upward, your loss is limited. The second approach is more aggressive. In this case, traders can use the last lower high, which is the highest point from the previous drop, as the stop level. This strategy carries a bit more risk but allows you to stay in the trade longer and conceivably increase your profit. When setting a target for the inverted cup and handle pattern, the most common method is to measure the height of the cup and project the price downward. Take the distance between the top of the cup and the bottom support of the handle, then apply the same distance downward from the breakout point to estimate the target. This approach uses the measurable structure of the pattern to give a reasonable idea of how far the decline could go. The price might not always reach this exact point, but this method provides a systematic and objective reference for setting a target. In short, measuring the height of the cup and applying it from the breakdown point is the most reliable and widely used way to estimate how far the price could fall with the inverted cup and handle pattern. Guys, there are a few must-know rules for the inverted cup and handle chart pattern to really work. If these conditions aren't met, the shape you see on the chart is just a curve. Let's look at the key points that make this pattern valid. First, there usually needs to be a prior decline or a weakening trend. The price should already be showing weakness, and the inverted cup and handle indicates that the downtrend could continue. Second, the size of the inverted handle is very important. The handle should not be deeper than about 1/3 of the inverted cup. In other words, it shouldn't exceed roughly 30 to 40% of the cup's height. Otherwise, the pattern loses validity. Third, pay attention to the shape of the inverted cup. It should form an inverted U shape rather than an inverted V shape. A slow, rounded peak shows that the market has gradually tired. Sharp inverted Vs often lead to quick reactions. Fourth, consider the time frame. Higher time frames, like daily or 4-hour charts, make the pattern more reliable. Shorter time frames, like 5 or 15 minutes, can produce more false signals due to market noise. Fifth, volume gives important clues. During the cup formation, volume usually decreases, showing that buyers are losing strength. At the breakdown, an increase in volume confirms that sellers are taking control. Guys, finally, it's important to watch out for common mistakes traders often make. The inverted cup and handle is a very strong pattern, but there are some repeated errors you should definitely avoid. Mistaking every rounded peak for an inverted cup, ignoring a handle that is too deep, or completely overlooking volume movements can all lead to mistakes. Other frequent errors include ignoring the overall trend or rushing into a trade before the breakdown happens. Keeping these points in mind will help you use the pattern more safely and consciously. Here are the main mistakes to avoid. Assuming every rounded peak is an inverted cup. Ignoring a handle that is too deep. Completely ignoring volume movements. Not using a stop loss. Ignoring the context of the trend. Entering a trade before the breakdown occurs. Guys, now let's check out the first real chart example. On this chart, the inverted cup and handle chart pattern appears very well. First, the rounded peak forms the inverted cup. Then the price makes a short upward move, forming the handle. The entry was taken once the support below the handle broke. After the breakdown, selling pressure returns to the market. The stop loss is set above the breakdown point to keep risk under control if the price moves upward unexpectedly. The target comes from measuring the height of the cup and projecting that distance downward from the breakout point. The price moves steadily toward this target, showing how the pattern plays out. This chart is a strong example of how the inverted cup and handle works when the formation, entry, stop, and target are all properly set. Now, let's move on to our second chart. This example will show how important patience and confirmation are after a breakdown. Looking at the chart, another nearly perfect, inverted cup and handle price pattern has formed. The neckline, or support level, is very easy to spot. After the handle is complete, the price doesn't head straight to the target like in the first example. Here's what happens. The price breaks the neckline downward with strong momentum, giving us our first confirmation. But immediately after, it moves back upward with hesitation. We call this a pullback. This pullback tests the broken support as a new resistance, a retest. Traders often hear the saying, old support becomes new resistance. That's exactly what's happening here. The price tries the previous support line, fails to gain strength, and is pushed downward again. The retest gives us the second and strongest confirmation. After this point, sellers take full control, and as you can see, the price drops sharply and heads toward the target. This example teaches an important lesson. Waiting for the pullback and retest instead of entering immediately reduces the risk of getting caught in a false breakout and provides a much more reliable entry point. Now, let's check out the third chart example. This chart already shows a downtrend. The price continues moving downward with lower highs and lower lows, and within this decline, an inverted cup and handle pattern forms. The key point here is that the pattern appears within the existing downtrend, rather than signaling a reversal. The inverted cup and handle acts as a structure that confirms the continuation of the trend. After a brief recovery, the price breaks the support at the bottom of the handle, and selling pressure accelerates again. The price then resumes the downtrend from where it left off. This example shows perfectly how the inverted cup and handle works as a continuation pattern and why watching the trend context is so important. Guys, if you found this video helpful, please hit the like button to show your support. If you're not subscribed yet, join the channel for more simple and easy-to-follow chart explanations like this. Drop any questions you have in the comments and let me know what you'd like us to cover in the next video. See you in the next lesson, and take care.